Have you ever looked at the news, seen some really troubling economic headlines, then you glance over at the stock market and it's hitting another all-time high, and you just think, what on earth is going on here? If you feel like the world of finance is playing by a completely new set of rules, well, you're not alone. So let's get into it. Let's try and solve this puzzle.
Right. This is the big one. This is the central mystery we're going to tackle. Because on one hand, you've got all these economic indicators that have historically just screamed recession. But on the other hand, you've got a market that just keeps climbing. It seems totally deaf to all the warnings, and it's this disconnect that has even the most seasoned pros just scratching their heads.
You know that feeling that the old, reliable rules of economics are just stopping? It's becoming more and more widespread. And we're going to break down exactly why that is, because it's not just a feeling you're having. It's a fundamental change in how the entire system actually works now. And the key word here is neutralized. I mean, for decades, investors had this toolkit of really reliable signals, things like bond yields or manufacturing data. Today, those same signals are flashing bright red, but the market's engine just keeps on humming. It's kind of like all the warning lights on your car's dashboard are going crazy, but you realize someone has just cut the wires to the engine. So what we're seeing, it isn't just some temporary glitch in the system. No, we are literally witnessing a massive shift from one distinct economic era into a completely different one. And it's a change so profound that it's rewriting the entire playbook for investors, for central banks, and for governments. Okay, so this slide really gets to the core of the power shift. For the last 40 years, we lived in an era of monetary policy dominance. The central banks, like the Fed, they were the undisputed kings. They steered the entire economy with interest rates. But now? Well, now we're in an era of fiscal policy dominance. The power has actually shifted from the central bankers over to the politicians. Their spending decisions are the new primary driver of everything. And in this new era, there are two just colossal new forces that have emerged, and they are bending the market to their will, often in ways that completely defy traditional logic. So let's break down exactly what they are. Okay, so the first force is the sheer, unbelievable size of automated investing. We're talking about passive index funds, algorithmic traders, quant funds, the whole shebang. And together, they now make up more than half. Let me repeat that, more than half of the entire market. They don't trade on whether a company is a good value. No, they trade based on pre-programmed rules and momentum. Their scale is so immense now, they aren't just playing the game anymore. They are the game. This quote, this just perfectly captures the human side of this insane new reality. This was a fund manager who admitted to buying wildly expensive stuff, not because he thought it was a good investment, but because the rule-based funds were buying it, which was forcing the price up. In this new world, you can be 100% right on the fundamentals and still lose your job if you try to fight that overwhelming momentum. It's wild. Now, the second force, and you could argue it's even more powerful, is this idea of fiscal dominance. So what is it? Well, it's the market's newfound rock-solid belief that governments, especially the U.S. government, will no longer allow a significant crisis to actually happen. Any sign of serious trouble will just be met with a fire hose of government spending and support. The government has basically become the ultimate buyer of last resort. And you know what? The market learned this lesson the hard way, through a whole series of near disasters. Back in late 2022, the UK bond market nearly imploded. Then, in March 2023, Silicon Valley Bank and Credit Suisse just collapsed. I mean, any one of these events could have sparked a global meltdown. But each and every time, governments stepped in with overwhelming force to just bury the problem. The lesson for investors was crystal clear. The safety net is real. So the results of these two forces, you've got automated momentum on one side and a government backstop on the other, is one of the strangest things we've seen in modern finance. A market that has all the classic signs of a bubble, but it's a bubble that just refuses to pop. So just how strange is it? Well, let's look at one of the oldest valuation metrics in the book, the price-to-earnings ratio. It just tells you how expensive stocks are compared to their actual profits. Right now, for the U.S. market, that number is 29.8. And to be blunt, that is incredibly, incredibly high. But let's put that number into context for you. This valuation, it's as high as the absolute peak of the dot-com bubble back in 2000, right before that market crashed in a really spectacular way. So by any historical measure, we are in some seriously thin air right now. And this right here, this gets to the absolute heart of the matter. If it looks exactly like the dot-com bubble, why isn't it popping? Well, it's because this isn't your classic bubble driven by pure human emotion and speculation. It's a structural bubble. It's being mechanically inflated by passive funds that are forced to buy no matter what, and a government that's promised to catch the market if it ever falls. So all of this leads to the single most important takeaway from this entire explainer. If the market feels less risky these days, it's not because risk has somehow magically vanished into thin air. It's because it has been moved somewhere else. Let me say that again. The risk isn't gone, it's just hidden. All of those fundamental dangers, over-leverage, bad bets, economic downturns, they all still exist. They've just been taken off the market's books and kind of tucked away out of sight. So where did it go? It's been transferred, basically, onto the government's balance sheet. Now just think about what that means. When the government absorbs the market's risk, asset prices completely stop reflecting reality. The whole system has way less of a buffer for shocks. And it means the biggest risk we all face is no longer economic, it's political. It all depends on the government's willingness and ability to keep footing the bill. So what could happen if that hidden risk comes roaring back into view? This is where it gets pretty scary. These numbers, they show just how fragile this system really is. If a crisis forces long-term interest rates down to just 2%, the market could plunge 30%. But if the market loses faith in that government safety net and rates spike to 7%, we could be looking at a devastating 75% collapse. The stakes are just immense. And this leaves us with the final, pretty unnerving question. Risk that is hidden can't stay hidden forever. Sooner or later, it gets found. And in a system that has completely forgotten how to price for danger, what happens on the day that risk finally comes out of hiding?